Liquidity risk management refers to the potential ability of a financial institution to generate fresh liabilities, either to cope with any decline in liabilities or increase in assets. Implicitly, therefore, liquidity risk management involves managing the two conflicting objectives for any financial institution. One, a liquidity crisis in the bank could have serious ramifications in terms of its reputation. Hence, most well-run banks do all possible to eliminate liquidity risk. Eliminate potential liquidity risks. Financial institutions will be required to invest in highly liquid assets which are short-term in nature, or in risk-free instruments such as government bonds, in both of which the yields would be very low. In other words, managing liquidity risk involves potential reduction in interest income and therefore an adverse impact on the overall profits of the bank. We will now look at some techniques used by financial institutions to manage liquidity risk. The most fundamental one is the fundamental approach. This approach involves investing in assets that can be turned into cash easily. Example, investment in treasury bills and government securities, and or complying with regulatory measures such as maintaining cash reserves, statutory liquidity reserves, etc. On the liability side of the balance sheet, the focus should be on source of funds. For example, source funds that are likely to remain with the bank for an extended period of time, rather than funds that could be withdrawn at short notice. Furthermore, banks should carefully analyze its cash inflows and cash outflows, and based on that gap, source funds ahead of need. Do remember, financial systems in most countries would have a judicious mix of retail banks that are implicitly deposit rich, hence liability led, vis-a-vis wholesale banks or corporate banks that are asset led and always hungry for funds. The second approach to manage liquidity risk is the technical approach. The technical approach essentially focuses on liquidity in the short term. This is achieved through two methods. The first one is called the working funds approach, and the second is called the cash flow approach. Let's look at both of these approaches in some detail. First, working funds approach. This involves segregating the source of funds, that means the liabilities that are coming up for maturity in the near term, into three categories: volatile funds, vulnerable funds, stable funds. Volatile funds includes funds that are sure to be withdrawn when they come up for maturity. For example, based on past data, the bank has determined that out of a deposit base of 10 million currency units, 3 million currency units of certificate of deposits and fixed deposits will be withdrawn when they mature. That leaves 7 million CCU out of the 10 million CCU. Vulnerable funds includes funds that are likely to be withdrawn on maturity. In the above example, let's say 4 million CCU of the remaining 7 million CCU are vulnerable. Assuming, based on past data, 50% probability of withdrawal, the cash outflow for the bank would be a further 2 million CCU. That means 50% of the 4 million CCU of vulnerable funds. Stable funds represent those funds with the least probability of withdrawal when they come up for maturity. In the example that we saw, the 3 million CCU of the 10 million CCU that is remaining can be classified as stable funds and therefore most likely to be rolled over when they mature. Based on the above arithmetic, the bank's effective cash outflow will be 5 million CCU in the immediate future, comprising of 3 million of volatile funds which are sure to go away and 2 million CCU, which is 50% of the 4 million vulnerable funds. Good liquidity risk management by the bank requires that they proactively source sufficient liquidity to meet the expected cash outflow of 5 million in the near term. Now let's look at the cash flow approach to manage liquidity risk. This is also referred to as the maturity ladder model proposed by the Bank of International Settlements. In fact, several central banks around the world have mandated this approach for liquidity risk management to all the institutions that they have an oversight responsibility. This approach involves laying down the planning horizon, or the buckets as they are normally referred to, and estimating the cash inflows such as loan repayments, inflow of fresh deposits, etc., as well as cash outflows by way of loan disbursement, closure of deposits, etc., in each of those planning horizon or buckets. A bank forecasts these cash inflows and cash outflows for each of these buckets and determines the liquidity needs for each planning horizon with specific focus on the short term. Let's look at a spreadsheet example to understand this better. What we have here is 4 planning horizons: 1 day, 1 week, 1 month, 6 months. Along the y-axis, we have various items of cash inflow, such as maturing assets, that is loans and bonds that are maturing in that coming planning horizon, assets that are available. They are not maturing, but they are available for sale if required. Therefore, they could be used for liquidity management. Then the potential for additional deposits, open borrowing limits with other institutions, and portfolio that is ready to be securitized. There could be other lines of cash inflow, but in the example I have taken only these. Now, if you look at the cash outflows for this particular institution, maturing deposits unlikely to be renewed, which means that will be a cash outflow. Loans that have been committed, which are likely to be drawn down by the borrowers. Fresh investments in bonds and securities that the institution would like to make, and setting aside some cash for unforeseen events. So these are the cash outflow items that we have considered. There could be other items of cash outflow, just like there could be other items of cash inflow. Now, if you look at, for example, the planning horizon for the next 24 hours, what it shows you is the CCU in millions that are likely to inflow against each of these line items, and the total adds up to 163 million CCU. And the cash outflows indicate against each of those line items what is the cash outflow. For example, 47 million CCU of maturing deposits that are unlikely to be renewed, and therefore the cash will go out of the bank's system, and so on and so forth. Now this adds up to 155. The net cash flow is positive, which means 163 cash inflow minus 155 cash outflow, which gives you a total of 8 million CCU. So in other words, as of close of business tomorrow or the next working day, this institution is likely to be in the money by 8 million CCU. Now if you look at the next time horizon, which is 1 week ahead, you have total cash inflows of 107, total cash outflows of 120. So the institution is out of the money by 13 million. That's why the negative sign, which is arrived at as the difference between 120, which is the cash outflow, and 107, which is a cash inflow. Now on a cumulative basis, minus 13 plus 8 gives you a figure of minus 5. Now what this denotes is ceteris paribus, everything remaining constant, this institution would expect that 1 week from now it would be out of the money by 5 million CCU. And if you take this forward to 1 month, the cash inflows are 76, the cash outflows are 99, the institution is out of the money by 23, that's why the minus 23. Cumulatively, therefore, minus 5, which is carried over from the previous planning horizon up to 1 month, turns out to be minus 28. Now, this is not a very happy situation for the bank, but it can still cope with it because in the long term, its cash inflows amount to 131, whereas its cash outflows amounts to only 79. So if we were to look at a 6 month time horizon, this institution is in a pretty happy state because it is 24 million CCUs in the money. So what it needs to manage very carefully in terms of its liquidity is this minus 5 and this minus 28. It does not have a liquidity problem on an overnight basis. It does not have a problem if you look at a planning horizon that is 6 months ahead. Hope that spreadsheet example helped you understand how the maturity ladder model proposed by the Bank of International Settlements is used by financial institutions to manage liquidity risk. Asset securitization is another method used by several financial institutions to manage liquidity. This involves taking future cash flows such as repayment of long-term loans, mortgage loans, etc., and repackaging these cash flows into negotiable securities, issuing them to investors, and realizing those future cash flows immediately on a discounted basis. We will discuss asset securitization in much greater detail in a later session in this course.